Welcome, ladies and gentlemen, to the Cima F3 Essentials Revision segment, especially on transaction risk management, or basically a much bigger component related to financial risk management. I might dig a little deeper than absolutely necessary for the strategic case study, especially in terms of certain aspects, certain technicalities. But the primary objective that you must fulfill is to understand that these instruments are available, how they work, and therefore, or through that, what situations might actually permit us as a financial manager, as a treasury manager, to utilize which instrument. That is the key skill that is expected at the strategic case study exam, on top of various scenarios like evaluating whether a certain use of a certain derivative or hedging instrument is appropriate to that particular situation. Let's take a look. So before we get started, a gentle reminder, please have a notebook and pen on the ready. Do follow the slides and my explanations carefully, take down notes, and maintain a list of doubts, clarifications, and maintain a list of key topics that you feel you're weak at, so you can definitely self-revise later and ensure that you stay focused. In addition to that, I would also, perhaps related to taking down notes, I would perhaps recommend, if you feel like there might be certain tools that you could use, maybe the note can be a little bit thorough. Let's get started. So as usual, I would want to give you a quick reminder on the core activity related to F3, and as you know, out of the 5, only one is related to F3, which is recommend financing strategies. And if you closely pay attention, in fact, the truth is that financial risk management or derivative instruments, especially hedging instruments, are not embedded, seemingly not embedded. Evaluate suitability of sources of finance, recommend dividend policy, recommend and apply business valuation models. But what I can tell you is the mix of financial management and financial risk management as far as your knowledge with respect to these kind of transaction risk management techniques are concerned. First of all, we have to try and understand, or we basically have to remember, what the different types of foreign exchange risks are. Firms may be exposed to 3 types of forex risk. First one is transaction risk. This is the risk of an exchange rate changing between the transaction date and the subsequent settlement date on an individual transaction, associated normally with exports, imports, and we can hedge this using a variety of financial products and approaches. The second type is economic risk, includes the longer term effects of changes in exchange rates on the market value of a company, present value of future cash flows, or basically the exposure of risk that those future cash flows are subject to. Looks at how changes in exchange rates affect competitiveness directly or indirectly, and can be reduced by geographic diversification, being exposed to multiple currencies, much like portfolio diversification, but in terms of currency. The third one is translation risk. How changes in exchange rates affect the translated value of foreign assets and liabilities, especially of foreign subsidiaries, when you translate and prepare your final accounts. So this is more of a book value related, values in the book. It's something rather more accountancy and treatment, bigger translation treatment related risk rather than a material risk itself. Gains or losses usually are unrealized, so many firms do not hedge, can hedge by borrowing in local currency to fund investment. There we go. Those are the 3 key types of foreign exchange risk a company can be exposed to. Now, this particular piece is going to be focusing on 2 elements. One is forex transaction risk and the other is interest rate risk. The first key area is hedging foreign transaction or forex transaction risk. Hedging for accounting purposes means designating one or more hedging instruments so that their change in the fair value is an offset in whole or in part to the change in the fair value or cash flows of a hedged item. I know, a little bit technical, but the idea is that we somehow come up with a way to match the risk of the foreign currency movement, to match and fight it back, fight against any kind of adverse risk. If we know that currency might depreciate, if we feel like currency might depreciate, what can we do to ensure that we have something in place that will match that depreciation? So we will either the impact to us will be minimal, or there will be no losses or minimal losses. A hedged item is an asset, liability, firm commitment, or forecasted future transaction that exposes the entity to the risk of changes in fair value or changes in future cash flows, designated as being hedged. And a hedging instrument is a designated derivative or another financial asset or liability whose fair value or cash flows are expected to offset changes in the fair value or cash flows of a designated hedged item. So what you can basically see is that we try to, it's basically a combination of assets and liabilities, promises, commitments. You would have noticed assets, liabilities, or firm commitment. So it's basically a play of those elements related to finance. Arguments in favor of hedging reduces the risk and therefore encourages investment in new ventures and projects. Sure, can provide greater certainty of cash flows. And arguments against incur significant transaction costs. These are not easy to facilitate at all, can be complex and misunderstood, particularly if derivatives are used. Raises complex accounting and taxation issues, and shareholders may prefer to accept the risk in order to obtain potentially greater rewards. There we go. So those are the arguments in favor and arguments against hedging. Now, transaction risk management. Now, as we previously identified, is one of the three types of currency risk. There are several methods of managing the exposure to transaction risk. As a general rule, the simplest and the most convenient methods are used by most businesses. So as you can see, there are internal approaches and there are external approaches. Internal with no exposure to third party, no links, no transactions, no movements between any third party entity. Any actions we undertake with ourselves, within ourselves, can be classified as internal methods. External is where we tap into the various platforms that the capital markets allow in most cases. The differences between internal and external hedging can be very significant. Internal hedging is often more effective for dealing with economic risk and is often cheaper and simpler to understand, which I hope we will see down the line. And external hedging is more complex, so it is usually undertaken by skilled staff in treasury departments. As you know, treasury is a key department that usually, at least for large entities, manages this entire area. Now there we go. Here in this slide, what you're seeing is basically a quick snapshot, a Kaplan extract, of course, for the internal methods that we have: invoicing in home currency, leading and lagging, forex or foreign currency bank accounts, and matching. Let's take a look. First one, invoicing in home currency. Insist that all the foreign customers pay in your home currency and that your company pays for all imports in your home currency. So I mean my payment gateway is in USD, so it's not really a hedge. I mean, not that I would have preferred to charge in the local currency, but if you take, for example, it's more of a facilitating matter. But generally, given the situation, given the country you're in, right, that is why wherever you're in the world, any Zoom payment, any Microsoft payment, any Google payment, any YouTube payment, every single thing, all the transactions don't happen in the local currency. All of them happen in their home currency, or in this case, the United States dollar. The exchange rate risk has not gone away. It has just been passed on to the customer, who may not be too happy and may look for an alternative supplier. In a competitive environment, this is an unrealistic approach. So not very popular, and you need a lot of bargaining power to push for something like this, like those examples I cited. Me. And the second approach that we are going to look at is leading and lagging. In order to take advantage of foreign exchange rate movements, companies can try to use leading payments where you pay in advance, or lagging payments where you delay your payments beyond your due date. For example, with a lead payment paying in advance of the due date, there is a finance cost to consider because you're paying earlier, right? This is something, this is your capital. Is the interest cost on the money used to make the payment, but early settlement discounts may become available. So anyone who has operational level content fresh in their memory, there is under working capital management, there is a situation where we assess whether we would go for an early payment where we offered an early settlement discount, or will we wait. So while there is no derivative involved in that particular aspect, the pitch here is that with respect to large payments that you're making in a foreign currency, do you pay before? You might save some. Do you pay on that date, exactly on the transaction date at the spot rate, or do you pay later? These are things to consider. The third one is mainly matching. So matching, offsetting, netting, pooling, all of these have a very similar nature to how they work. We'll take a close look at each of them. So matching is fairly simple. A company can reduce or eliminate its foreign exchange transaction risk exposure by matching receipts and payments. Wherever possible, a company that expects to make payments and have receipts in the same currency should plan to offset its payments against its receipts in that currency. And the process of matching is made simpler by having foreign currency accounts with the bank. Using the same account for receipts and payments should reduce bank charges. Offsetting, matching payments against receipts, will be cheaper than arranging a forward contract to buy currency and another forward contract to sell the currency, provided that receipts occur before payments. But if they don't, the company will need to leave a positive balance in the account to avoid it running into overdraft. So that has to be taken care of. And the time differences between receipts and payments in the currency is not too long. So these are two, I would say, conditions where offsetting or matching, in this case matching, would really be beneficial if these two are true. Any differences between the amounts receivable and the amounts payable in a given currency may be covered by a different instrument or a settlement. A forward exchange contract can be used, etc. So, I mean, if you basically owe someone USD and you're supposed to get USD for the same amount, what you can simply do is ask your supplier or ask your buyer to pay your supplier on behalf of you. Matching. There we go. Offsetting, netting and bilateral netting, let's take a look at it. Again, I told you they are very similar. The objectives are to avoid the need to convert cash or pay bank charges. Conversion and paying bank charges, these requirements, you're trying to minimize yourself engaging in these two activities by netting off intercompany balances before arranging the payment. Many multinational groups of companies engage in intra-group trading. When related companies located in different countries trade with one another, there is likely to be intercompany indebtedness denominated in different currencies. So what do? Netting is a process in which credit balances are netted off against debit balances, so that only the reduced net amounts, the net amounts remain due to be paid by actual currency flows, especially within the group, intra-group. In the case of bilateral netting, only two companies are involved, When there are more companies, you call it multilateral or multilateral netting. The lower balance is netted off against the higher balance, and the difference is the amount remaining to be paid. Fairly simple. So it's almost like matching but intra-group. Multilateral netting occurs when several companies within the same group interact with the central treasury department to net off their transactions. The arrangement might be coordinated by the company's own central treasury or alternatively by the company's bankers. So treasury, this is the third time we are seeing the term treasury. Remember that the treasury department, I think I touch on the treasury aspect and how important treasury is in another F3 segment as well. Remember that treasury can be a very useful team, especially for large corporations with a lot of transactions going through the company. So here what happens is a base currency is established to record all intragroup transactions and an agreed exchange rate. All the subsidiaries inform central treasury of their transactions with each other, and central treasury then informs each subsidiary of the outstanding amount payable or receivable to settle the intra-group transaction. So again, it's not bilateral because there are many parties involved. What you do is you match anyone who owes to anyone who is supposed to get some cash, match all that, and the outstanding amounts are what finally materially exchanges hands. This has the advantage of reducing the number of transactions and thus transaction cost, including foreign exchange purchase costs and money transmission costs. Loss of interest from having money in transit is also avoided. However, it requires strict control procedures from central treasury. Also, some countries severely restrict or even prohibit netting because it is seen as a means of tax avoidance. And there may also be other legal and tax issues to consider. That is multilateral netting. And finally, pooling. So pooling is a system of managing cash when a business has several bank accounts in the same currency. It might be able to arrange a system with its banks whereby the balances on each bank account in the same currency are swept up into the central account at the end of each day, leaving a zero balance on every account except the central account. So this is more facilitated by whichever financial institution that your company is working with. OD balances, overdraft balances, and positive cash balances are all swept up into the central account, maximizing interest earned and minimizing any bank charges or interest payable. Especially there's a benefit when you have multiple bank accounts within the same bank. Anything that you transfer among these bank accounts will almost all the time have no bank charges. So if you can net all those balances off to zero and bring it into a central account, maintain the records properly, blockchain can be very useful here as a technology. It's a good way for a large company operating multiple accounts in the same bank. This does not provide a system for hedging against FX risk, as you would have already figured out. More of a minimizing transaction related matters, because if you have 10 bank accounts and if you want to do transactions through all the 10, getting money out and putting money into all the 10 accounts from the external ecosystem, that is going to be a little bit expensive. You know how banks are. But can be an efficient system for cash management. It avoids OD costs on individual bank accounts, and it enables the treasury department to make more efficient use of any cash surpluses. There we go. That is offsetting in the terms of how we can pool. So if we take an additional look at this, for an efficient system of cash pooling, there needs to be a centralized cash management system. The current organization allows each subsidiary to operate their own cash management system. Pooling can be organized by each subsidiary. However, it might be even more efficient if subsidiaries operating in the same currencies share the same pooling system. Hence, is best operated by a central treasury function. Of course, because you need to have a proper view on what is going on. I mean, if you let individual departments deal with them, they will have limited visibility, only access to their particular bank accounts. But if you have a central treasury function, it's going to be very easy, because they will have a holistic 360-degree complete view on what is going on, what are the transactions, and have a better placement to manage all these transactions effectively. And finally, in terms of internal hedging methods against forex transaction risk, counter trade. So it's very simple, honestly. Counter trade involves the exchange of goods and services of equivalent value, meaning that there are no currency exchanges. So much like the traditional barter system, where you exchange goods or services that have an equal value. While it is not something we hear of very often, I can assure you it is something that happens a lot. It is a means of fixing the exchange rate in terms of commodities, and it is most effective when the commodities are generic and can be sourced from anywhere, so that purchase price will not depend on exchange rate movements. Now, if there is a possibility that the commodities price may vary significantly worldwide, these movements can be hedged using commodity futures. However, there may be issues with the taxation authorities if this method is used, as the authorities may query the value of the transactions. So that is the only sort of hiccup. But if you can really get into an agreement with all the parties involved, this is one efficient way without cash exchanging hands, get something done. So that brings me to the kind of end of internal hedging methods. But before we wrap that up and move on to the next part, let's take a look at factors to consider prior to protecting. So protecting against transaction risk, we must be careful. There are things that we need to carefully think about. These factors may include one of obviously future exchange rate movement, where the currency is very volatile. The future movements in exchange rate may depend on a number of factors, including interest rate, inflation, central bank actions, and economic growth. The availability of a market for the currency in question, the cost involved in the hedging, like any commissions, transaction costs, etc., the ability of the company to absorb any forex losses, expertise within the company, like if you really have a treasury, do you have one? If you have one, are those who are in treasury truly capable of managing this? Because this is really when you get hands down and really dig deep and put yourself right into the middle of that situation, it doesn't really present itself as an easy context to operate in, and it's money after all. The company's attitude towards foreign currency transactions will also matter a lot, and the importance of overseas trading. There we go. Those are key factors that you would consider prior to deciding whether you would protect or not, and as a follow-up, how you would protect or not. So that brings me to the external methods, and here you have a snapshot of the methods that are relevant to us: forwards or forward contracts, money markets, or hedging through money markets, currency futures, currency options, and currency swaps. Let's take a look. Firstly, forward exchange contracts, perhaps the simplest. And a forward contract is an agreement to buy or sell a specific amount of foreign currency at a given future date using an agreed forward rate. So today, you're basically agreeing to a future transaction and the rate at which you want to do this transaction at. Very simple. This is the most popular method of hedging currency transaction risk. The company is able to fix in advance exchange rate at which a transaction will be made. The risk is taken by the bank, who are better able to manage their exposure. A proportion of the exposure will normally be avoided by writing forward contracts for opposite trades on the same day. And forward trade contracts, you must remember, are a commitment. As a result, they have to be honored even if the rate in the contract is worse than the rate in the market. So Sure, they are popular because mostly people guess correctly where a transaction is going to, or where forex um, where the forex movement is going to head toward. But sometimes it could go completely in the opposite direction than which you anticipated. In such a case, if you have already gotten into a forward rate agreement, you must honor that commitment. Forward contract rates are often quoted at a premium or discount to the current spot rate. Let's look at advantages. They're transacted over the counter and are not subject to the requirements of trading exchange. So basically, just over the counter, you can get into a forward rate agreement with any person, depending all the prerequisites are fulfilled. OTC, over the counter. They can, in theory, be for any amount. The length of the contract can be flexible. Contracts are generally for less than 2 years. They have low transaction costs. Disadvantages: the organization may not have the protection that trading on an exchange brings, right? So when you're actually using trading platforms that capital markets have built, you might have a little extra protection. It anyway all boils down to the entity that you're dealing with and their level of honesty and honored commitment. The contracts are difficult to cancel as they are contractual obligations. There is a risk of default by the counterparty. So counterparty risk or credit default risk is there. A point of note, so you can take a quick look at this as you go through the video, just a couple of important matters that I feel like would be useful for you to have a understanding of. This is one reason I've added a few points of note. One reason why I said that I might be going a little bit extra in terms of detail as far as the slides and some pieces of the presentations are concerned. All right. The second instrument we are looking at is money markets and money market hedging. So first of all, what are money markets? You know, capital markets. The money markets are markets for large-scale lending and borrowing or trading in short-term financial instruments. Many companies are able to borrow or deposit funds through their bank in the money markets. Instead of hedging a currency exposure with a forward contract, a company could use the money markets to lend or borrow and achieve a similar result. Hedging using the money markets, the basic idea of a money market hedge to create assets and liabilities that mirror a future asset or a liability. So if you have a future liability, you create an asset today. If you have a future asset, you create a liability today. The basic rule is this: the money required for the transaction is exchanged at today's rate and is then deposited or borrowed, asset or liability, on the money market to accrue to that amount required for the transaction in the future. Simple. The basic idea is to avoid future exchange rate uncertainty by making the exchange at today's rate. See how it works. So here you have a simple snap I've extracted from Kaplan. A money market hedge eliminates risk by ensuring that currency is translated immediately at spot rate. So for example, here if you have a payment in the future, you borrow the home currency, right? Your commitment is you have a payment to make in the future. So what do you do today? You borrow the home currency and exchange it into the foreign currency now. Then you deposit that foreign currency and wait. At the future date, you use that grown foreign currency deposit and make your payment. That's how you deal with that situation. But what happened was that the action you took to deal with that future payment was today. So you have that sense of certainty because you took a particular action on today's spot rate. Now if you have a receipt in the future coming in, a payment coming in to you, somebody owes you money, what do? Today you borrow the foreign currency and you exchange it into the home currency today. and then you deposit the home currency. And eventually at the date of the particular receipt, you use the eventual receipt to pay off the foreign borrowing. So what happens is that if you have a forex payment coming in, you borrow money today because you know anyway you're going to get a payment, and that loan, you settle that loan by the future receipt on that particular date. Fairly simple. This is how money market hedges work. So in a sense, it's really not a technical hedging instrument. It's more utilizing the chance, the opportunity that money markets present to us by creating an asset or liability today to set off against a future asset or liability. Advantages: ensure there is no currency risk because the exchange takes place today, have fairly low transaction costs, offer flexibility, especially if the customer delays payment. Disadvantages: they are complex. It may be difficult to get an overseas loan in the case of a foreign currency receipt, and has obvious cash flow implications which may prevent a company from using this method. Example, if a company has considerable overdraft, then they might not be able to work in the capital markets. They might really not have a lot of access to capital funding in the capital markets. It might be very difficult to go and ask a bank to lend you some money. That is what it means. Yes. Then the third one, currency futures contract. So again, what I want is for you to understand this in very simple terms. Technically, it's very similar to a forward contract. Very, very similar. In essence, this form of hedging is very similar to the use of a forward contract. The critical difference, okay, then, is that whereas using a forward contract requires the preparation of a special instrument tailor-made for the transaction, currency futures are standardized contracts. So you can't tailor-make it. They're not over-the-counter. They are standard contracts for fixed amounts of money for a limited range of future dates. So they are pretty much exchange traded. Futures are derivative contracts and as such can be traded on futures exchanges. The contract which guarantees the price, known as the futures contract, is separated from the transaction itself, allowing the contracts to be easily traded. That's why basically you can buy and sell futures contracts as a sort of like buying any goods from the market. Futures contracts are limited to a small range of currencies and are typically denominated in terms of USDs. There are also markets in Euro. Futures are available in standardized contracts for standardized amounts. So if you go to a bank who is linked to a futures exchange, and you ask them, okay, I want to get into a futures contract, they will tell you, okay, we have 200,000 USD contracts, we have 500,000 USD contracts, and each of these contracts, the maturity dates are set to either you can get for March, June, September or December. What do you want? They'll ask you. It's like ready-made forward contracts available for you on an exchange that you can purchase. In essence, we are hedging or speculating on the movement of the exchange rate on the futures market. There we go. Advantages: transaction costs are generally lower. The exact date does not have to be known in terms of receipt or payment of the currency, because the contract does not have to be closed out until the actual receipt or payment is made. Because futures contracts are traded on exchange regulated markets, counterparty risk is relatively reduced and buying and selling contracts is easy. Disadvantages: the contracts cannot be tailored to the user's exact requirements. Standard sizes, standard durations. Hedge inefficiencies are caused by having to deal in a whole number of contracts and by basis risk. So basis risk, if I just simplify it for you, you would have noticed here the futures contract does not have to be closed out until the actual cash receipt or payment is made. No. So if your actual cash receipt or payment, for example, let's say is going to be made on the 15th, but your contract end date is on the 20th, there's those 5 days, right? There's a small gap. There's a small impact to the entire transaction value and the final net gain or loss that you're going to make. That is the basis risk. That risk piece is what you're subject to, because you might have made a gain for the entire duration of the contract, but if you have that basis time, that additional time, sometimes whatever loss you're going to make on that might be bigger than the gain you make from the contract, and in such a case the entire hedging exercise hasn't proved very fruitful for you. So that is why we consider basis risk as a key element when you do, especially if you have done work on futures, especially for F3 OTQs. You know this. Only a limited number of currencies are the subject of futures contracts, although the number of currencies is growing, especially with the rapid development of Asian economies. Using the market will involve various costs, brokers' fees, transaction costs, etc. And the users will also need to make a deposit and maintain a margin account, because it's an exchange that is dealing with it and they want to minimize their risk. So because of that, they definitely would want you to maintain a certain account with a certain deposit, because if you default, they want to minimize that, or if the other party defaults, whoever is subject to, they want to be on the safe side. And it's a daily closed account, which is a technical aspect you don't need for the SCS. The next instrument is currency options. So options like that, they are options. The currency option is a right but not an obligation to buy or sell a currency at an exercise price on a future date. So it's a right, not an obligation. If there is a favorable movement in rates, the company will allow the option to lapse to take advantage of the favorable movement. The right will only be exercised to protect against an adverse movement. That is the worst case scenario. As a result of this, options sound very attractive, but they have a cost. So the premium is also going to be a little high because it's an option, you know. So you know that if things go well for you, you're going to make a buck on that. But if things go bad for you, then you can stop yourself. If the currency movement is adverse, you can stop yourself from exercising because you have that right to not exercise it. And that is also an advantage, right? You're minimizing your losses, so that definitely comes at a premium. Because options limit downside risk but allow the holder to benefit from upside risk, the writer of the option will charge a non-refundable premium, there we go, for writing the option. It is possible for the holder of the option to calculate the gains and losses on using options. Now, the discussion of the value of options does not just relate to currency options but is relevant to interest rate options also, which work in the same, like very closely, shadows this same exact structure. For example, the company may wish to purchase an option to buy a factory which is under construction. In which case, depending on, especially with respect to the previous example, in which case the particular company might have the option to either buy or not, right? It doesn't buy the factory or not. Currency options. So a currency option does not have to be exercised. Instead, when the date for exercising the option arrives, the importer or exporter can either exercise or let it lapse. The exercise price may be the same as the current spot rate. If so, we call it an at-the-money option, or it may be more favorable in the money or less favorable out of the money to the option holder exercising the option. If the currency movement is adverse, of course, the option will be exercised in a way that the hedge will not normally be quite as good as that of the forward or futures contract because of the premium cost. But if the currency movement is favorable, you will let the option lapse and the result will normally be better than that of the forward or futures contract. This is because the option allows the holder to profit from improved exchange rate. So basically the idea is that you're using a hedging instrument to stop something bad happening, not to stop something good happening. So if something good is happening, you let it happen. If something bad is happening, adverse movement, you exercise your right and you stop, you limit it. So there are two types mainly, put and call options. Call options give the buyer of the option the right to buy the underlying currency. Right to buy is called at a fixed rate of exchange, and the seller would be required to sell the underlying currency at the rate, obviously, counterparty. Put options give the buyer of the option the right to sell the underlying currency at a fixed rate of exchange, and the seller would be required to buy the underlying currency at that rate. So a little bit of a extra technicality which might not, which is unlikely to be tested in terms of, you know, exactly what kind of option do we need to exercise here, etc. But in simple terms, remember, the call option is a right to buy. Could be any commodity, but in this case, right to buy the currency. Put option, some call it put option, the right to sell the underlying currency. Those are the two. Advantages: they cover the risk of adverse rate movements and enable the option holder to take advantage of favorable rate movements. The purchaser has a choice of exercise price and date, and therefore a premium. Disadvantages: the cost depends on the expected volatility of the exchange rate. Options must be paid for as soon as they are bought. Tailor-made options lack negotiability, and traded options are not available in every currency, much like futures contracts. And then we arrive at one of the final external forex transaction risk management tools. We learn swaps, and by and large there are two types of swaps. You would have heard forex and currency swaps. Now, in very simple terms, forex swaps are very straightforward. A forex swap involves the swapping and reswapping of an agreed equivalent amount of currency at an agreed rate for an agreed period. It's a swap of a fixed sum for an agreed time period at the agreed rate. So it's a fairly straightforward deal. But a currency swap is where you're swapping interest rate commitments on borrowing in different currencies. So somebody is, and both of you are borrowing to fulfill the other's needs and holding the responsibilities as well, not only of the principal but also of the interest payments. Includes both the swap and reswap of principal and an exchange of interest rates. So your syllabus looks at mostly currency swaps, given the straightforward nature of forex swaps. You're swapping interest rate commitments, including the principal and the interest payments. Okay, so a swap is an arrangement whereby two organizations contractually agree to exchange payments on different terms. It could be in different currencies, or one at a fixed rate or other at a floating rate. So that is where interest rate swaps come in. In a currency swap, the parties agree to swap equivalent amounts of currency for a period. This effectively involves the exchange of debt from one currency to another. So there is debt involved, there's borrowing involved. That's why you have an interest commitment swap as well. Liability on the main debt is not transferred, and the parties are liable to counterparty risk. If the other party defaults on the agreement to pay the interest, the original borrower remains liable to the lender. In practice, most currency swaps are conducted between banks and their customers. An agreement may only be necessary if the swap were for maybe longer than a year. Let's look at it with a brief example. Consider a UK company X with a subsidiary Y in France, which owns vineyards. Assume a spot rate of £1 to 1.6 euro. Suppose the parent company X wants to raise a loan of 1.6 million euro for the purpose of buying another French wine company. At the same time, the French subsidiary wants to raise 1 million pounds to pay for a new up-to-date capital equipment imported from the UK. So X needs 1.6 million euros, and X is the UK company. So the UK company needs 1.6 million euros in France, and the French company needs 1 million GBP, sterling pounds, in the UK. Now what can happen is both those companies can borrow on behalf of each other. There we go. The UK parent company X could borrow the 1 million sterling, and the French subsidiary could borrow the 1.6 million euros, each effectively borrowing on the other's behalf. They would then swap the currencies and the interest commitments also. There we go. This is how currency swap very simply works. It's not a complicated idea. It's a very simple idea, very practical idea as well. I've included an additional example here again for your benefit, a little bit more illustrated. What you can do is, as you go along this, you can use the pause button and take a good closer look at this. Just read through it slowly and you will see how exactly numerically it works. One of those additional pieces I wanted to add. Benefits: flexibility. Swaps are easy to arrange, as seemingly or very obvious, right? Are flexible since they can be arranged in any size and are reversible. Transaction costs are low, only amounting to legal fees since there's no commission or premium. Market avoidance: the parties can obtain the currency they require without really subjecting themselves to the uncertainties of the forex markets. Access to finance: the company can gain access to debt finance in another country and currency where it is little known and consequently has a poorer credit rating than its home country. It can therefore take advantage of lower interest rates than it could obtain if it arranged the currency loan itself. Financial restructuring: so currency swaps may be used to restructure the currency base of the company's liabilities. This may be important where the company is trading overseas and receiving revenues in foreign currencies, but its borrowings are denominated in the currency of its home country. So swaps can be a means of reducing that exchange rate exposure, especially when you have multiple countries, multiple currencies involved. Conversion of debt type: at the same time as exchanging the currency, the company may also be able to convert fixed rate debt to floating rate or the other way. This is what we call thus it may obtain some of the benefits of an interest rate swap. Liquidity improvement: a currency swap could be used to absorb excess liquidity in one currency which is not needed immediately, create funds in another where there is a need. So it's quite flexible. Costs are very minimal, and you can easily get access to finance. You can utilize this in managing your capital structure with very little exposure, and even make it as a sort of injection, smart injection to your liquidity position. Disadvantages: there is always the risk of default by the other party to the swap. Position or market risk: the company whose main business lies outside the field of finance should not increase financial risk. Sovereign risk: there may be a risk of political disturbance or exchange controls in the country whose currency is being used for a swap. Arrangement fees: swaps have arrangement fees payable to third parties. Although these may appear to be cheap, this is because the intermediary accepts no liability for the swap. So the third party does, however, suffer some spread risk as they warehouse one side of the swap until it is matched with the other, and then undertake a temporary hedge on the futures market. So that's actually an additional piece, because there are facilitators to swaps, people who facilitate swaps, people who are always on the lookout for companies who are looking for swaps, and that is where they might be exposed to a certain spread risk, because they might have something in place and now they said they'll do something, so now they have the money in the hand and they're looking for a third party, a viable third party. During that time there could be a certain element of risk exposure. And that is a look at currency swaps. With that, we move on to interest rate risk. So here, what do we have? Exposure first. The exposure to interest rate risk will depend on the amount of interest bearing assets or liabilities that it holds and the type that these are floating or fixed. Now, that's the thing. If you don't have any assets or liabilities related to kind of debt or interest bearing, then you don't have any exposure to interest rate risk. Types of interest rate risk exposure. Obviously, there are floating rate loans. If a company has floating rate loans, changes in interest rates alter the amount of interest payable or receivable, and that directly has an impact to your cash position and liquidity. If you have a fixed rate loan, if a company has a fixed rate loan, interest rate risk exists. Even though the charges themselves will not change, a fixed rate can make a company uncompetitive if the costs are higher than those with a floating rate. And in such a situation, if the interest rates fall, the floating rate bearing companies are in a better position than the company that would have fixed rate loans. That is where the risk exposure lies. How do we manage interest rate risk? So quite very similar to how we have exchange rate risk management. We have internal and external methods here. Internal methods, so internal or operating hedging strategies for managing interest rate risk involves restructuring the assets and liabilities in a way that minimizes this exposure. These include: 1. Smoothing. The company tries to maintain a certain balance between the fixed and the floating rate borrowing. So you have a mix of both. You have a mix of fixed and floating rate. The portfolio of fixed and floating rate debt thus provides a natural hedge against changes in the interest rates. There will be less exposure to the adverse effects of each, but there will also be less exposure to favorable movements. Fair enough. And because you have a mix. Matching, where the company matches the assets and liabilities to have a common interest rate. So you have loans and investments, both have floating rates, where you're making certain interest fees, interest payouts, while you also have certain commitments, so you can basically match them. Netting is where the company aggregates all the positions, multiple positions, both assets and liabilities, to determine its net exposure. So these are the three simple approaches. Interest rate risk management is not a heavy duty area in terms of technical terms, but it is important that you have a fairly decent understanding of how all this works. External methods. So here you go. These are the 4 key approaches we have. But if you classify them between OTC, over-the-counter instruments, and exchange traded, you have fixing and insurance instruments. Fixing under OTC, you have forward rate agreements. Insurance instruments, you have interest rate guarantees. Under exchange trade instruments, you have fixing interest rate futures, and insurance instruments, options on interest rate futures. So actually, interest rate guarantees and options on interest rate futures are somewhat they have a very close or similarity. Let's take a look. Firstly, forward rate agreements. An FRA is a forward contract on an interest rate for a notional future short-term loan or deposit. So much like a forward rate agreement with currency, you agree for terms today. An FRA can therefore be used to fix the interest rate on a loan or deposit starting at a date in the future. It is a contract relating to the level of short-term interest rate, such as 3-month LIBOR or 6-month LIBOR, and FRAs are normally for amounts greater than sterling £1 million. The FRA does not replace taking out the loan, but rather the combination of the loan or deposit for the counterparty and the FRA results in a fixed effective interest rate, and you know that interest rate, what that interest rate is going to be at a much earlier date, on the date you're getting into this agreement. How do you set up the hedge? Hedging is achieved by a combination of an FRA with a normal loan or deposit. Borrowing, the firm will borrow the required sum on the target date, and this is usually done. You apply an FRA if you're concerned about interest rate rises, and will thus contract at the market interest rate on that date. Previously, the firm will have bought a matching FRA from a bank or other market maker and thus receive compensation if rates rise. So that's a sort of a matching technique to the risk that you're taking with the FRA. Depositing, hence concerned about a fall in interest rates, the firm will deposit the required sum on the target date and will thus contract at the market interest rate on that date. Previously, the firm will have sold a matching FRA to a bank or other market maker and thus receive compensation if rates fall. And in each case, this combination effectively fixes the rate, mostly at the spot rate. So that brings me to interest rate guarantees, also generally known as interest rate options. Now, interest rate guarantees are options on FRAs, forward rate agreements, but you can also have interest rate options on futures, right? They have this similar nature, but you will notice that in that similarity itself, you have an exchange traded instrument right here. On FRAs, so interest rate guarantees are options on FRAs, so the treasurer has the choice whether to exercise it or not. IRGs are also referred to as interest rate options or caps or floors. They are over-the-counter instruments arranged directly with a bank and have a maximum maturity of 1 year. So basically, if you have interest rate options on FRAs, they are OTC. If you have interest rate options on futures, they are exchange traded. They have a maximum maturity of 1 year. A company wishing to borrow in the future could hedge by buying an FRA, so would need IRG that provides a call option. A company wishing to deposit in the future could hedge by selling an FRA, so right to buy and right to sell. Right to buy, a call option; right to sell, a put option. The company would only exercise the option to protect against an adverse rate movement. So if you have an adverse movement, you exercise. If you have a favorable movement, you let it be favorable. Sure. IRGs are more expensive than FRAs, as one has to pay for the flexibility to be able to take advantage of that favorable movement. That brings me to interest rate futures. IRFs are similar in principle to FRAs in that they give a commitment to interest rate for a set period, but they are tradable contracts and operate for set time periods of 3 months and terminate in either March, June, September or December. As with currency futures, the futures position will normally be closed out for cash, and the gain or loss will be used to offset changes in interest rates. The future operates by the customer making a commitment to effectively deposit or borrow a fixed amount of capital at a fixed interest rate. Example, the notional sterling deposit or loan on the London Futures Exchange is sterling pounds of 500,000. So basically very similar to FRAs, but set time periods, traded on an exchange, and have pre-drawn tradable contracts. Interest rate swaps. So I think we had a brief look at how interest rate swap can help within a currency swap. An interest rate swap is an agreement whereby the parties agree to swap a floating stream of payments for a fixed stream of interest payments and vice versa. There is no exchange of principal, In practice, interest rate swaps are probably the most common form of interest rate hedge used by companies because they can hedge borrowings of anywhere between a year and 30 years and therefore can be used for long-term borrowings. Why would we use interest rate swaps? As a way of managing fixed and floating rate debt profiles without having to change underlying borrowing. To take advantage of unexpected increases or decreases in rates, to hedge against variations in interest rates, to benefit from comparative advantage, that is to achieve more favorable interest rates. So when you look at why we use swaps, well, it's easy in a sense, especially if you can find the right counterparty. The entire facilitation is easy. They're quite flexible. You can get into long terms, you can get out of them depending on the contract you draw up, and you can actually use it as a means of benefiting through favorable interest rates when you're switching between fixed and floating. Cross currency swaps. So here, these allow a company to swap a currency it currently holds for a different currency for a fixed period and then swap back at the same rate at the end of the period. The company's counterparty in a cross-currency swap would generally be a bank. That is to achieve more favorable interest rates. So here, small typo, please disregard that. Basically, what we are seeing here is that when you're dealing with a currency swap, you're swapping currencies across to either jurisdictions, you can have an interest rate swap, especially if there's a loan attached to it that helps facilitate the entire transaction. And that brings me to the end of this particular segment on financial transaction risk management, especially on the forex side, and we also looked at transaction risk management on the interest rate side. As you can see, do keep working and enjoy the process. As I always say, learning is always, it's something that is very productive, something that always adds value to you, and something that you can truly enjoy. On that note, that is the end of this segment. Until I see you next, stay safe and cheers. Good day to all of you.